Okay, and thank you for everyone at Winvesting for organising such a great event and having me on, and thank you to you all for sharing a bit of your day with me. Let's get started here. We've got this is one of my favourite topics to talk about. I've been speaking about this primarily for the last couple of months. We obviously do a lot of different presentations, but this one is near and dear to my heart, and perhaps one that I feel is the most valuable to traders of all kinds, whether you're trading stocks, futures, options, forex, because ultimately what this is about is talking about the underlying blueprint of what makes anything technically move, and how these markets are ultimately structured from a top-down process. Just a quick poll of the audience. How many people have actually have heard me speak before, or even speak about this topic before? Okay, no. Excellent. So I won't be, I'll hopefully be new for most people. That's great. Okay. So the whole idea tonight is to really kind of get stuck into some real technical stuff, and of course we'll get to a Q&A towards the end, and spend the last 15-20 minutes talking about that. And so just for obviously disclaimer's sake, I'm happy to take questions on lots of live market conditions, talk about stocks that we just bought into today and so forth, but it is for educational purposes only, not a recommendation to buy or sell. But the basic agenda for today is to, again, break down the markets from a top-down perspective. So look at what the real market directions and cycles are that we go through, and how we play into that, and then what role the smart money plays in how moves are executed and orchestrated. And I do say orchestrated because the market is very well orchestrated, not chaotic as a lot of people are led to believe. And once we've discovered that, we'll talk about a process-driven way that we can then start predicting market direction versus reacting to what we think and hear. We'll then touch on the checklist we can develop and how we can start utilizing scans, and that's when we'll get to the Q&A and talk about some of those live positions and so forth. So just a quick second poll of the audience is what type of traders everyone here is. And I ask this because this will then allow me to kind of to gear some of the examples and live stuff that we show you more towards where most of the audience is kind of geared towards. Myself, so you know a little bit about me, I'm a day trader and a swing trader. However, I prefer the term target trader, and I'll explain that because I think it ties in very well with the topic of tonight, or today. I believe that the market is very well constructed. I believe the market operates on levels. So just like if you were to walk into a 10-story building, that elevator is going to go from floor 1 to 2 to 3 to 4 to 5, and so forth. It's not, the elevator doesn't go from floor 5 to 5.5 and turn around, hopefully, or stop. And I believe the market works the same. I believe that the market basically operates in very defined absolute levels that are on the chart whether you see them or not. And these levels, therefore, can be predicted. And it's my opinion that a stock or an equity or an index doesn't change unless it hits one of these levels. So if you can become an expert at finding where these levels are, you're able to say, well, if the stock bounces off this level, it'll either break it and fail and go to the next floor down, or it will rally up and go to level 6, one of the two. So I believe you can predict levels, but I believe that sometimes it's hard to predict time and how long it might take for that to happen. So as a target trader, I focus on finding where the highest probability levels are that a stock or index will bounce, and buying at that point, and then selling as soon as it hits the next level. Now, whether that can sometimes mean a 10% profit in a day, like we saw with NQ yesterday, NetQuin Mobile, We thought that would take a week. It took a couple of hours. It could also mean you think it's going to take a couple of hours, and it could take a couple of days. So that's why I don't restrict myself to just these two boxes, and we'll get onto that as we can continue. So the other maybe more important question is, how does everyone make their decisions? Who here is using scans already? Are we looking at news, tips from friends, newsletters, things you're familiar with? This is a photo of Vancouver. That's where our office is. Because that's also the first input of how an investment comes to us. It's what type of funnels of information do we take these ideas from? So as a trader, the idea of what we want to be doing is trying to take all of these different types of feeds and funnel them into some format. Because trading is a business, and we need a business plan. Just like a business, when an idea comes to us, we need to be able to qualify it and say, you know, is this something that fits our plan? Is this a trade that we're familiar with? Is this is something that fits our model of what we found to be consistently successful? And because most ideas come from some kind of emotional background, it leads to mistakes because people have emotional decision making. And I've had repeatedly in the last few weeks, especially because of this volatility we've been having, people have been saying to me, you know, John, people tell me, you know, not to average down. People tell me, you know, that I'm buying into emotion and believing in and taking too much risk and so forth. All these kind of common mistakes. Don't chase stocks. So, you know, a great opportunity comes up. Maybe it's a breakout, and it rallies up 20%. And you know, the trader says, you know what? I've been taught, don't chase stocks, don't chase breakouts. And then the next day it's up another 50%. And then, you know, Joe Bloggs, let's call him, kicks himself and says, damn it, had I had a little bit more guts, I would have been able to make 50% today. And you're already spending the money you didn't make in your mind of what you could have done with that. So then the next trade comes along, and it looks just exactly the same, you know, and you grab your keyboard and you say, right, this time I'm not going to be such a fraidy cat. This time I'm going to get in, and you buy, and then it's down 30% the next day, and then you average down, you buy more, and then it's down another 20%, and all of a sudden you've wiped out 20% or 30% of your account. I see this happening all the time, and then of course now you change your rules again to never do that again, and now you're afraid to pull the trigger, and now you miss more opportunities. So I guess what I'm getting at is that I find that people are constantly so confused as to what the actual system should be that they're always changing their rules if they even have a consistent set of rules in the first place. Is this familiar to anyone? Is this a process that people have been through or maybe are going through? It's something I've been through. I think everyone has, and this is why 90% of people lose money. We are very, very good at losing money, and the market knows it. The stock market's one of the best run businesses in the world because it's very well designed to take money from for the people that know how to trade, to take the money from those who don't. Because as people, we're predictable. We like to buy when we feel good, and we sell when we feel bad. And perhaps that's why, as investors or anyone who's ever bought a stock that we believe in, it's hard to sell. Because we buy it when we feel good about the company, that they've got something really, really valuable. But as the stock climbs 10, 20, 30%, it's hard to sell because we still feel good about that company. We still believe in it. So how can we get rid of value? Again, this emotion is what creates lack of profits. Because we invest emotionally and lack strategies that tell us, not based on feelings, but based on proven statistics of when we should get out. And that's the question you'd ask yourself. If you ever find yourself looking at a stock where you've bought it and it's gone up 15–20%, and you're sitting there looking at it saying, well, what do I do? Should I sell it and take profits, or is it going to go up another 15–20% and I'll end up kicking myself? How do you make that decision? So ask yourself, if there was someone sitting next to you who was able to say, well, Joe Bloggs, if you were to take 1,000 other charts over the last 5 years that looked exactly the same as this, that with the same kind of volume, the same kind of move, and the same kind of pattern, if you took 1,000 of the same patterns, basically, 700 times out of 1,000, this stock will shoot down after reaching this level. Well, then your decision would be easy, wouldn't it? It should be. But again, because people lack that kind of foresight, that kind of overall perspective, a lot of people are unable to make that decision. And so this is what today is all about, is starting to get into the hard-nosed guts of the market, and stop being sucked in by the market makers that want to trick us out of our money, because that's all they're doing. You know, if you're the owner of Goldman Sachs, or if you're Carl Icahn or whoever, and you own $1 billion of Apple, and you have a very strong instinct that Apple's going to crash, the last thing you're going to do is tell everybody else you think so. Because if you've got $1 billion of Apple, then what do you need in order to get out of it? You need $1 billion worth of buyers to save your butt, to buy it off you. So the market is designed like this. So let's strip away the noise and let's start talking about what the market is, and from a top-down approach. The market is built on, obviously, we talk about Dow theory. There's 3 directions a market can go: up, down, and sideways. Really simply put, obviously an up market is higher highs and higher lows. We probably all know that. I'm going to argue that that is misleading and wrong, in fact, in many ways later on. And so I'll take that challenge and I'll tell you why. Downward trending markets, lower lows and lower highs, I'm going to challenge that definition also. And sideways markets, of course, what we're having at the moment, where we are range bound. But the main point about pointing out these 3 different market directions isn't so much the definitions of them, but the fact that we do have 3 directions to take advantage of. One statistic I read stated that 80% of traders only traded long, which blows my mind, because that's only 1/3 of the direction. That would be like having a retail company selling toothpaste, for example, like they do up here in Canada. There's a high density of both French and English-speaking people. So you go to the store and you pick up any product, basically, and it has French and English on both sides. Because it'd be foolish to not take advantage of a massive part of the market. So then why do traders not trade short? And further still, to get more advanced, why aren't we taking advantage of when markets go nowhere? You don't need to sell in May and go away. You can sell in May and go away. You can make a lot of money if the market goes nowhere, if you know how to do it. So that's the first thing. We can profit from all market conditions. The next thing, which is less explained and less educated about, I find, is the different market cycles. And what I mean by that is we want to talk about the differences between oscillation, consolidation, and momentum. Because the differences between, for example, oscillation and momentum are as different as a long is to a short. How many people here have never been taught or have never been brought up to speed on the differences between these types of market cycles? Okay, a few people. It is drastically different. So let's take the average person who picks up Investing for Dummies. You know, what are going to be the strategies taught when you pick up a book like that? They're going to talk to you about the 9-day moving average and the 20-day moving average, and when a stock crosses above those, or that it's a buy signal, Or perhaps you've learned about MACD, and when MACD crosses positive, it's a buy signal. Or when RSI, Relative Strength Index, goes up over 30, that it's a sign of a stock recovering and it's a buy signal. Great. All those things are valid, but only if you're dealing with momentum. So you go and try and apply those strategies to an oscillating stock, you're going to lose your shirt. And who's done that? I mean, who's found that frustration? That you see a stock bottoming, and it turns around, crosses up over its moving averages, MACD looks like it's going positive or neutral, and you buy, and it goes straight back down the next day, stops you out. Okay? Chances are you've tried to apply a momentum strategy to an oscillating stock. Because if we're dealing with oscillation, then we're going to deal with a completely different set of variables. We don't look at moving averages at all. And we don't look at MACDs and things like that. What we look at is we look at extremes, CCIs, Keltner channels, Bollinger Bands, horizontal and trend line based support. And that's the definition basically between the differences. Is what controls the stock. Now, when you see a chart like this, the key thing to dictate is what is controlling the stock's support and resistance. Okay, so in an oscillating stock, you'll see that the moving average, which I've got plotted here on the chart, which is the 9-day, the stock goes straight through it, up and down, as if the moving average isn't there at all. Okay, what does control the movement are 3 static lines that we can see across the chart. Now, what we then see is once this stops working, the very first time this stops working is here. That's our first signal that the trend is changing. The personality is shifting to a new cycle. And this is when we get the bouncing back and forth between this consolidation pattern. Okay, so we go from a downward expanding channel, which tells us where our buy and sell points are, then to an oscillating consolidation pattern, being a ascending triangle, and then when that breaks, which is here, we then shift again into momentum. And all of a sudden now the trend lines, the static areas, are no longer valuable. The things that are now valuable is what's driving the stock, which is the moving averages, the black line. Okay, now, so all of this kind of goes in, there's a comment that you won't know where it stopped working until 14 days later. Well, the moment you know it stopped working is here, right there where that bottom little bulb is, and the moment you know that pattern wasn't working anymore was here. And the way that you know it's not working is because it's broken support. So, for example, we'll use some live scenarios. Why don't we throw up a live chart here? Are there any stocks that are hot on people's mind right now that we can use as an example in terms of where oscillation and momentum can kind of come together? Apple, PNC, okay. I see quite a few. I'm sure we're going to have an interesting Q&A session then at the end. All right. We'll switch over to the chart window. Just coming over. Facebook, IBB. Okay. It's just popping up on the screen. And just as it does that, the consolidation obviously is a type of oscillation, but it is obviously considered to be directionless. So there is a way we can predict that direction, and we're going to be talking about that later as well. So okay, so let's go over to we've got the screen up here in front of us. Let's have a look at Apple. Okay, so if we're dealing with Apple, one of the first most important things to determine whether we're dealing with oscillation or momentum is, again, first and foremost, we need to know what is the stock listening to, what seems to dictate how it moves. So the first, obviously, few things we can look at is the 9 and 20-day moving average. So we look back in December. This is not momentum at all. You can see that the stock does not listen to the moving averages whatsoever. So what we do, and always, and this is one trick that is very important, whenever you're drawing trend lines, a lot of people just arbitrarily draw in lines. They'll go from here to here, or they'll go from wherever the left-hand side of the chart is, right-hand side of the chart is down, or then they'll go from here to here. And I've seen some terrible trend line drawing in my days. So how do you know where the real trend lines are? The trick to identifying where the real trend lines are and then knowing essentially when a pattern's therefore been broken is by going left to right. Ignore what's on the right-hand side of the chart and go left to right. And that allows us to see that the pattern has been broken there. And then we rally up, retest, and off we go. And for those of you technicians in the audience, you may notice that this is in fact a bullish pattern. This is a falling wedge, which would indicate, because the trend lines are drawn correctly, that a bullish move was about to occur. We then go into momentum mode. So we know this is broken as soon as this candle happens. We then go into momentum, and this is broken at the moment that this breaks, which is then here. Okay. Do you need more than 2 touches to draw a trend line? No. Because in fact, a trend line is really only valuable up until 3 touches. We'll talk about that later too. Okay, so then we go from momentum to a breakdown. We're now in oscillation mode. Excuse me, here we go. We're divergent. Excuse me, we're going sideways. We don't know exactly where we're going to go yet. We have a break to the upside. We continue. And now we're dealing with another kind of a possible momentum turning into consolidation. And if we look at what Apple looks like, we can currently see that we are in a descending triangle, which looks exactly like the S&P 500. So right now we are in oscillation mode. What is the pattern? We are in a descending triangle. And therefore, what is the probability of this chart telling us? The probability is telling us that it should be a breakdown. Now, where do all these patterns come from? Well, these patterns come from the DNA of trading. And what that is starting to look at where trends start and end and what defines a true trend. We'll come back to a lot of live stocks here in a moment. So with a trend, as we said, typically it's higher highs and higher lows defines uptrends and downtrends. But how do we detect when that ends? Well, the very simple definition, which we just started on, is that as soon as whatever's defining that trend stops working. So as soon as the lower highs and lower lows changes, or as soon as the pattern is broken, whatever that case is. When is a trend uncertain? What is consolidation? As we just looked at, for example, on Apple, if we saw this entire time, this consolidation, or as you call it, a sideways triangle, why is that consolidation? Well, it basically comes back to the DNA of trading, the basic inside and outside day definition. Because what we're seeing, if you were to look at just a point and figure chart, where it basically just tracks movement, and you looked at that chart of Apple, all you're seeing here on that chart is a bunch of inside days, where the range is getting smaller and smaller and smaller. That's all that is. When you look at Apple and you look at that trend, what you're just seeing is a pattern that's made up of a bunch of inside days. So a consolidation pattern is simply inside days repeating each other. And the same thing if we were to get a pattern that maybe was less common, where we get maybe a kind of a diamond formation. What do we do there? Well, it's the same thing. Based on the DNA of trading, it's actually exactly the same as the previous. it's a consolidation because it's a combination of inside and outside days. So rather than knowing the buzz terms of diamonds or wedges and things like that, we can just know from the basics what's going on. And the same can be defined with borderline days. So a quiz to the audience here, just to test everyone's technicals here. Most people would consider borderline days as unknown as well. But let me ask you this. I'm going to argue that they are not simply unknown. There is actually a direction. So if we look at the scenario here, I've just put a square around. Is this more bullish or more bearish? What does everyone think? And it's usually always a split audience, so don't be worried about having a go. Okay. All right, great. We have a split audience again, almost exactly. Okay, this is actually more bearish, and let me explain the reasons why. When we look at a stock, when we're looking at levels, we're trying to examine the level of strength of the buying or selling. And so this level represents the supply of buyers. How strong is that buying? Think of it like jumping on a trampoline. Is the force of that trampoline pushing you higher, or are you becoming lower? And every time the stock hits this support, the buyers were able to push it up quite high the first time, but on the second iteration, they were able to push it lower, which means that essentially the buyers were unwilling to pay higher prices and that sellers were more powerful in pushing it down. And so if you want to think about if we were to duplicate these lines, much like we did before in consolidation, what would we get if we kept drawing lower highs and equal lows? What would we get? What pattern is that? It's a descending triangle. And if you take a descending triangle and you took 1,000 of those descending triangles, you have over a 65% probability that it will always go down rather than up. So we talked about that at the beginning. What if you had somebody sitting on your shoulder saying that there was a 700 out of 1,000 stocks will always go down from here? Would you sell or would you hold? Well, I would always sell if that's what probability is telling me. And this is what probability tells us about equal lows and lower highs. A descending triangle is much more probable to break down than go up at all. And that comes back to this basic stuff. Okay, so test 2. What about here? What if we're getting equal highs and lower lows? Is that more bullish or is that more bearish? Just while everyone's answering, so there's questions. Can you draw a pattern on a market that means you're in consolidation? Yes, we'll get to that, no problem. Okay. Yes, everyone's correct on this one. Everyone agrees, bearish. Because yes, the selling power is becoming greater and the bulls are becoming weaker again. And that's why if we get a pattern where we're moving lower, sometimes the bullish optimist in people think, well, look, it's still holding those highs. It's going to break out. And the problem is that's not the likelihood. If you get an expanding range like that, chances are it's breaking further down. Okay, so these are some of the things that we need to be aware of. Yes, people can justify just about anything, and that's also the problem with how people often draw charts. When we get into charts, we often want to draw right to left because we want there to be support where we're buying versus resistance. We'll do one more live chart before we move on, just to kind of keep things real time. If we look at SanDisk, which is one actually which someone's asking about, this is one I've actually already got charted up. You can actually see that we've got two high probability patterns here. One, we have this was actually one that actually came up in our options during earnings scan as a short, and let me tell you why. It had an ideal pattern. So uptrending channels will generally revert to the opposite. So an uptrending channel will generally revert to the downside. So firstly, this was something that we were eyeing up for a short anyway, because it looked like a potential short pattern. And you can see that just before earnings were announced, it broke below that pattern. It broke below that trend line. Okay, so there's the first, and so there's a oscillation pattern, and here's your consolidation. If we connect left to right, you can see that we've actually broken out of that pattern here on May 27th. We've rallied up, and now we've retested exactly where the support zone is. So we're now in a possible another oscillation move, but certainly not momentum yet, because the moving averages haven't come into effect. Okay. So moving on. How do we define some basic rules about this? Well, the first thing is that now as we start to look at the DNA of trading, now we start to define, we can start getting a picture of what we're actually looking for. And you know, one of the analogies I use when teaching this is thinking about, you know, anything you buy in life, like if you're out shopping for a car. I mean, if you're out shopping for a car, you know what you're looking for. You want a four-door sedan, maybe it's a Honda. You want ski racks on the roof because you have kids that go skiing. You need 5 seats in the car, and you want airbags, and your budget's $25,000, right? You don't go out and hopefully come back with a 2-door sports car that costs you $70,000, or you wouldn't probably have that family much longer. You know, and it's the same thing, but people do that very same thing in the stock market. They go out there shopping for a stock, and they end up just buying anything that they come across with no real criteria that they're checking it against, and no real budget of evaluating whether they're getting a good deal or not. They're just hoping, and that's not the way to trade. We need to have a very specific shopping list. So for that, that's the only way we can get consistency. Without knowing where we're going, any road will take us there, and that's where inconsistency in trading comes from, is a lack of discipline, a lack of strategy. And if we are able to get discipline and strategy, then we can build scans that will find daily for us exactly what we want to find. If we know what we want to look for, let the computer do it. Why the hell would you sit in front of the screen waiting to find it where if you already know what you're looking for? Let the computer do it. That's what technology is. So to do that, to develop scans, we have to get a little bit more technical about what drives the market, where the high probability patterns are. So who does drive the market? Without putting a name to it, volume drives the market. And if we think about where that came from 30 years ago, it was all from value. It was from you and your family and other investors reading the newspaper, deciding what companies were good, getting to know the management, and buying based on that. So value was where volume came from. These days, we don't get our news from the newspapers or from radio. Or from the nightly news. Well, how do we get our news now? We get it pumped through our screens at hundreds of articles every few minutes. And so now, it's not even people reading that news. In fact, when the NASDAQ released a new news service a few years back, 65% of the subscribers were all computers, not even people. So, and the statistics are that close to 70 to 80%, possibly more, of all of the volume in the market comes from algorithms and high-frequency trading. I just spent the last 3 months living in Playa del Carmen down in Mexico, and I had the great pleasure of meeting one of the gentlemen that is responsible for one of these firms. And he's based out of Kansas City, Missouri, and he was telling me that their firm alone represent 10% of all of the volume in the U.S. market. and all they're looking at doing is trading the arbitrage between the different ECNs. For those of you who are a bit more technically minded, they basically simply look for when the island exchange is ahead of any of the other exchanges, and they pick up any stock that's behind, expecting it to absorb the difference. Anyway, without going into that, that's massive amounts of volume coming from purely algorithm bases, and billions of dollars are made. So if you look at the flash crashes, where markets plunged 3 months of value in minutes and then magically bounce back, that's because the algorithms have the power, and they're ultimately what orchestrates the maneuvering of so much stock. Now, there's a comment of, does that mean that they have massive amounts of capital? Well, yes and no. Because let me put it to you this way. Let's say that you have $100,000 and you go and buy stock ABC, and you buy it and you hold it. Okay? How much volume do you account for? Well, you account for $100,000 worth of volume. Now, what if I come along and I have $1,000 and I buy and sell that same stock within 5 seconds? How much volume do I account for? I account for $2,000. And let's say that I do that 100 times, or let's say 100 times. Well, now I account with my $1,000 for $200,000 worth of volume. So it doesn't mean they have 80% of the capital. It just means it's kind of like the mouse casting the shadow of the elephant. They whip the market by having that high frequency. But the beauty of it is how they whip the market, and the way this money moves is driven by rules that have been, some of them, been written for years and years. And they're patterns that are, reverse engineerable, because they're following the same rules again and again and again. So to reverse engineer these rules, we're not trying to beat them. We're simply trying to understand them so we can predict the fingerprint of when they're getting in and out, of what they're looking for. And when you are the Titanic getting in and out, you can see these levels. Okay, so firstly, let's come back to something I said at the very outset of today, which is that I believe that stocks and indexes do not change unless they've hit one of the following few things: horizontals, trend lines, or moving averages. And depending on which they interact with will tell you the pattern of the stock. So algorithms, in other words, don't see this, they see this. So flash crash. The area we ran down to was the same area that we previously recovered from a nasty correction in January of 2010. That level, and then where it rallied to, went straight back up to 1180 and down again. And one of the gentlemen we've done some work with, Adam Mesh, was on CNN, I believe, or Fox, being interviewed, and said, they said, "What do you think of that?" He said, "Well, it's great. We've just seen exactly where the market's going to go back down to for the next few weeks. Easy money." And easy money it was. It went straight back down to that same level. So the key is finding these strong levels. So the first thing I'm going to show you is how we find the strongest levels when looking at an oscillating chart. So remember, oscillation is where we are bouncing back and forth between two extremes, two static lines. So what we're looking for is when we look at a chart, we want to find out where is that static line that holds the most power. So when we look at a chart, let's say we bring up a 12-month time frame, and we'll say, okay, what we want is we want to see where a powerful level exists. Where is the fingerprint that the big money has just loaded up or sold off heavily? Okay, so the first thing we have to think about is, how does smart money buy or sell? Well, instantly. So the first thing we want to see is we want to see that a stock has come powering down. Let's say the stock trades $20, $30, $40 million a day, hits support, and doesn't do this, doesn't just kind of gradually recover, that's not high frequency. What we want to see is we want to see that. We want to see $30–40 million go from dropping 20% in a week to going straight back up 20% in a week on maybe no news at all. That can only be explained if the 80% of the market's behind it. Therefore, we're looking for a strong drop with a very reactive, instant, powerful recovery. So how much did it drop? How quick did it drop? And then how quick and how powerfully did it rebounce? That's the first rule. The second rule we want is to consider how fresh it is. So if you're a trader looking at a chart like that, and you say, that could be a powerful zone of support, are you more likely to feel comfortable buying the second time, the third time, or the fourth time? I guess my question is, would you be happy buying with more or less bounces? What's going to make you feel more comfortable? Buying at A or buying at B? What does everyone think? Excellent. Most people are saying less. And that's what I would say too, because the more times a trend line has been hit, the less probable it is that it will continue to work. And that's why when we're drawing trend lines and someone asked, can a trend line be valid with only 2 touches? Absolutely, because after 3 touches, I'm expecting it to not work anymore. And that's what I call the rule of 3. After a trend line's been used 3 times, it doesn't exist anymore to me. Okay, and that's the rules of oscillation. Basically, we want to see strong levels. We want to see it bouncing between those limits. Moving averages are therefore ineffective. And in a scenario like this, we're looking for those where the most powerful level is. And now this is the next kind of scenario that we then want to start adopting, is instead of now looking at charts and trying to determine what should we do with the stock now, the question, in my opinion, it's just my opinion, is instead of asking what we should do with the stock today, we should be asking ourselves, where is the best possible place to do anything with it? Okay, so let's look at this example. If I looked at this as a chart, I would simply be saying, right, where's the best place to buy? Would I buy here? No. Small movements, already been used twice before. Short it here? No. Small movements, already been used twice before. The only 2 places I'd be willing to buy it is here, where we've had a powerful level, and here, without being the second choice, because it's still fresh, but just less powerful. Only went down 2 levels versus 3 over here. So we start to plan our trades instead of reacting to markets. But most people don't do this because they're so afraid of missing out on the trade. So let me give you some examples. I'm going to bring up some charts here. Let's look at things like, these are stocks that I have open orders on at the moment. BGS, B&G Foods Holdings. The stock was rallying up the other day. You can see that it was coming up to strong gap down resistance. So this could have been a possible short. But I was chatting to a student, and when the stock was around kind of $30, and they said, well, what would you do with it? I think I'm going to go long. It looks like it's in a rally mode. I said, probably, but I wouldn't touch it at 30 bucks here. What I would do is I would short it at 31.20. And they said, well, why wouldn't you go long at 30? I said, well, because the probability, in my opinion, is that it's a much, much stronger short at 31.20 than it is a long at 30. And the other thing I have a standing order for is to short it up here between 32.40 and 32.60 with a stop loss at 32.80. Because then if it gets there, now that's another really high probability potential short. Another example, SHLD, Sears Holdings. This was one that, again, if we have a look at the trend line, significant, sharp rejections, straight up, straight down, straight up, straight down. So as soon as this hit 44.25, I shorted this. I had an order waiting 3 days prior to it getting to that price, that as soon as it got there, to short it. CMCSA, Comcast, another example. I have a standing short order to short this between $60.50 and $61. And I've got about 10 other stocks just like this that all have the perfect entry programmed. And I couldn't tell you what they are. I'd have to go look. And the reason for that is because I don't care. I don't care what the stock's called. I don't care what they do. And I ultimately really don't care how much percentage they represent in gains. All I care about is does it have a very high probability entry and exit target with a very good risk-reward ratio of at least 3 to 1. So I can program 20 trades in and just let them go trigger off in the background, and I know that as long as 1 in 3 are right, I'm breaking at least even. And hey, if I'm half decent at picking them, I'm actually making good money. So that's oscillation in a nutshell. It's about picking these types of levels and trading off of them, and so therefore you're now anticipating the move instead of reacting and taking potentially low probability trades. Okay, now so there's a quick snapshot of those rules. So yes, in terms of the John, the question regarding the swing low, I think on BGS you were asking about. Yeah. So for example, this would have been an oscillation pattern. You can see all this noise, verging on momentum. And my problem with that trade was that getting into it at $30.50 or something like that, in order to break overhead resistance, would have only given a $1.50 reward, and I would have wanted my stop loss down here below the low of this candle at 29.80. So for $1.50, for $1.50 reward for 80 cents of risk, it's just verging on a lower probability risk reward, and I just wouldn't have. It's still valid, of course. Just would have been. And I wouldn't have. My personal opinion is I wouldn't have bought it at 30, because at $30 it still hasn't shown itself to be a momentum trade, and if it's an oscillation trade, then the probability is that it'll bounce down off resistance here versus break out. But we'll talk more about that as we go along. I've got a couple more things to go, which will start filling in some gaps. So examples of oscillation trades: Aaron's, AAN, beautiful stock to follow if you like these types of trades. Huge rallies, same zones, massive rallies, trading 30 million bucks a day. Powerful stuff, bottom to top. 26.50, 32, 26.50, 32. Same thing. This is huge money. And this is where we start to get into indicators. Now, there's a good question that's just popped up from Ken in the audience. John, how do you determine if overbought is a strong trend or due to revert to the mean? That is excellent timing, because this is the answer. Momentum. So again, you may have noticed I like to talk in analogies, so I'm sorry if I do sound like a philosophy teacher, but it's how I find it easiest to communicate some of these ideas to a large group. But my analogy for this is imagine you've got two cars driving down the highway, and one of them, and they're both going the same speed, 100 kilometers an hour, or 60 miles an hour, and we're going towards a brick wall. One of them's going to smash through, one of them's not. It's not going to have a great day. How would you know which is which? Well, which is the heavier one? Which one is the 10-ton truck and which one is the smart car? Right? Because then the answer is obvious. Now, in the stock market, we don't have weight, but we do have momentum. And that is ultimately the difference, to come back to your question, Ken, of how we determine which stock is which. And as traders, we need to know that. If we see two stocks that we analyze that come up in our scan tonight that both look like this, right? That both look like that, then there's two possible trades that we have. We could find the same pattern and we could go long on one and short the other and make money on both if we know what we're doing. However, if we don't know how to determine which is which, we could go short one and long the other and lose on both. Right? So how do we tell the difference? Well, this is where momentum comes into play, and smart money, which we're going to get to in just a moment. In momentum, the difference is, as we approach these overbought levels, as we approach these levels of resistance, because the horizontal and trend lines are now no longer the ones in control, now because the moving averages are in control, the stock is not being bounced between two magnets kind of thing. It's not being bouncing back and forth between these levels. Instead, now the stock is being driven from beneath with momentum, and it's more likely to smash through these overhead resistances rather than break down. And this is when overbought becomes power versus a reversion back to the mean. So momentum is now what we want to be looking at. And the momentum indicators, such as moving averages above it, are now more so the levels that we want to be aware of. So momentum trades, we look at those moving averages. We look at when the stock is being supported by those. And where this now comes into a nice little tidy package is how we now consider the smart money as part of this process. Okay, so let's switch over to the charts. I mentioned earlier that you know, the definition of uptrends and downtrends I was going to challenge. If we were to go beyond higher highs and higher lows, what are other things that everyone in this room might consider to be true signs of an uptrend or downtrend? Any guesses? What else defines a true uptrend? Smart money, yes. Volume, thank you, Michael. Slope of the averages. Yes, actually that's a good point. If you have moving averages that are running parallel, that can be a sign. All right, well, let me give you what I consider a sign of a true uptrend. And this comes back to the DNA of trading. When you fill your charting program with indicators, what are some of the most common things that people look at? People look at stochastics. People look at directional movement. People look at on-balance volume. People look at volume in itself, all these kinds of things. But what is all that telling us? What it's telling us is there really a trend in place? That's why we look at indicators in the first place, right? Is there a trend that's strong? But what those things are really telling us is something far more basic. A true uptrend, here we go, just get my pen out. A true uptrend isn't just higher highs and higher lows, because what if, as we went higher, the range contracted? Well, what we should know about price action is that would be bearish. That would be a rising wedge. So as the range contracted, we're expecting there's a higher probability it's about to break down than go further up. That's a rising wedge, technical analysis 101. So firstly, if the range is contracting, that is not an uptrend I'd be interested in unless I'm shorting it. So that's the first thing. And also, what if that uptrend of higher highs and higher lows was closing lower and lower in its range? Well, that would be very bearish also. And what if this was occurring as volume dropped, showing there was less and less people interested in buying it as it climbed? Well, what we've pretty much done right now is, if we go back to that slide with that child with the crayon, we've just basically drawn exactly what I would be looking for an ideal short. So taking that into account, what is a true uptrend? A true uptrend is higher highs and higher lows, but we also need it to be accompanied by ideally an expanding range or equal range, but also closes in the top half of the range repeatedly, and the higher in the range the better, as well as increasing volume. And that's what your indicators are telling you. Directional movement is assessing higher highs and higher lows. Stochastics is measuring whether the stock is closing in the top half or bottom half in the range, and for how long for. On balance volume is telling you whether volume is accompanying the move or detracting from the move. So rather than going into information overload, let's make it really simple. Let's just look at one indicator that tells us all of that, which is money flow. And this essentially tells you where the smart money is going, because it accommodates all of those true factors of telling you, is money sticking or is money selling out into the rally, or in other words, selling to you. And so if you want to go and have a look at the big breakdowns in stocks, for example, BGS. Why was this a great short? Because as the stock climbed, this money flow was going completely out the back door. Why would I have not gone long at $30? Well, now I can tell you. Because if we look at where the stock is here at $30, money flow was down at negative 20. Whereas if we look at the stock over here, where it was also $30, money flow was positive 5. So basically, the stock has not changed in price at all over these two time zones. In fact, it had a really big high. But the smart money has absolutely flocked right away from it. Yes, I have been hiding the secret sauce. Because I don't like to throw everything in at once, because you need to, as I said at the start, it's so much more important to understand the why of each piece of ingredient, why it's valuable and the impact it has, versus just being told to do something because it works. The why is far more important than the what, I think, anyway. And anyway, so this is the why behind this. So behind this short, I believe with CMCSA as well. CMCSA, look at Comcast. We're up at similar levels. And in fact, this could be a possible short right now. I mean, if you were to get in a little bit early, but I think the ideal short is up here. But look at the money flow. Look at LinkedIn. So was anyone surprised to see LinkedIn plummet? I wasn't. This was a perfect opportunity for an options during earnings play, where you could have bought some 230 out of the money puts and cleaned up. Why was it high probability? Because of the insider selling, because of the institutional action, and without even needing to read that level of detail, you could also see that simply by looking at the chart. As the stock went sideways, the money flow went right out of it, and it plummeted. Look at some of the other really big quote-unquote surprises. Look at Netflix. last year. That was a big drop. There you go. But you can see as Netflix climbed, money flow declined. There's tons of examples of this. We'll look at some live stocks here as well. So money flow and the smart money are great examples. I'll show you on the long side. ATRA was a beautiful stock that we'd found earlier this year. We picked this at I think it was some of the students in the room might be able to remind me. I think it was thank you. Yeah, 18. It was $18 to $20 was the first trade. And if you can see here, what you've got is you have a frying pan pattern. It can also be known as a bump and run, and that's where the definition of that is you get a downward channel followed by a 65-degree or more break to the downside. Then so that's the frying pan's handle. Then you get the frying pan, the scoop at the bottom. You can also look at it like a spoon, and then the bump and run happens. This is a very high probability pattern, and what happens is it'll run up, hit the trend line, pull back, and then run. Bump and run. So trade 1 is from the bottom of the channel to the top of the channel, and trade 2 is from the bottom as long as it goes. I think we got out of this at $36. It went a lot higher, but we got out of it there. And I'm actually in this again right now. I bought this as it broke through $40 the other day. Now, the trick about the smart money, though, is look at what happened when we were being alerted to buy it. The price was significantly lower than where it was before, but the money flow had shot up. And this is where you then say, if you really want to be a tricky bird, you simply go into things like, you can go into insidercow.com. If you really want to know, because this tells me enough. This tells me the smart money's buying. But if you really want to go in and figure out some cool stuff, then you can go into something like insidercow.com, go to ATRA, and all of a sudden I noticed that just around the same time that we were buying, and in February, so were the directors, all about the same time. $1 million, 200,000, 200,000, okay. Institutional, same thing. And all of a sudden, as you look at the institutions, you also might notice some interesting things. You might see that Celgene, which is also a pharmaceutical company, was buying into this pharmaceutical company. Well, that raises an eyebrow. You may also notice that Carlos Slim, one of the wealthiest men in Mexico, if not the wealthiest man in Mexico, was buying as well. And we all know what Mexico is known for. I'm not going to say anything that he knew something or didn't know something, but when the wealthiest man in Mexico is loading up on a speculative company like this, I'm going to buy purely on that reason almost alone. This was an awesome trade, and this is all right here that you can get easily from Inside the Cow. So the way I like to trade is I like to search for when a stock is at key support levels. So here's that website again, if you didn't see that on the screen. Just punch in ATRA, and there you go. There's the information, and there's the institutions. There's Carlos Slim, there's Celgene. And in fact, you can even go in and actually look at their individual, what else they're buying. And if you really want to dig into it, you can go into the insiders themselves and have a look at what their history is or track record of picking good entry points. You can see what their history is, and this is updated daily. Great site. So we'll come back to some live stocks here, but this is what it's all about, is that once you start to piece together a better picture of what you're looking for, now you can scan for it. And And now you can start saying, right, I want to build a scan that finds me a stock that's in a frying pan situation where the money flow is accumulating, or in other words, diverging, where money flow is shooting up as stock is shooting down. And I want it to be in one of the highest probability patterns. Remember, there are 100+ patterns out there, right? So you want to think about that, you know, double tops. Well, keep in mind, there's Eve and Eve double tops. There's Eve and Adam double tops. There's Adam and Eve double tops. And there's Adam and Adam double tops. There's not just double tops. There's 4 different types. And this ranks 39 out of 100. This ranks 13 based on probability and success that we found. So I would never trade this, never trade this, maybe sometimes trade this, but most of the time what we're searching for is that. Why would you trade low probability when you can trade high probability? So you build a scan that looks for all the highest probability possibilities that you want. The pattern, the volume, what the candlesticks are doing, the money flow, that there's insider buying, institutional buying, all these factors. You can build it into that perfect recipe that you want if you know what you're looking for. And that then starts to open up the floodgates to efficiency, where you can start scanning the market every night, looking for exactly what you want. But again, knowing what you're looking for. What are the common things that people often make the mistake of is they try and trade everything, and you just can't, because there's so many different patterns and things. You need to really specialize and focus on that. And so don't trade every pattern. Trade the ones with the highest probability. And this is the definition, really, in my opinion, of efficiency. And the 4-hour work week talk, Tim Ferriss talks about the definition of wealth. And he asks the question, is a wealthy man the guy or girl who makes $100,000 a year working 60 hours a week, or is it the person making $60,000 a year working 10 hours a week? Now this is personal preference, so maybe everyone has their choice, but I would far prefer option B any day. And this is why I have that approach with trading. I would much prefer to run my scans each night as I do, and have 10 stocks per strategy to look at, and be able to be done all my research in an hour, maybe an hour and a half max. And yes, maybe I miss a few extra opportunities. I could spend 5 hours longer and maybe make a little bit more, but I'd prefer to spend 1 hour and make 80% of what I could make otherwise. That's kind of the process that I like to look at. Now, I know I'm going through a lot of information, but I try to, you're committing your hour and a half here to listen to me, so I want to make sure that, that you're getting value out of this to take away. And this is another big takeaway, is that once you start to do all these things, your job is now to focus on the same trade again and again and again. So I showed you some of those trades before, like BGS, and SHLD and CMCSA and all of those different things. It's all the same stock again and again and again. BIOS was another one that came down and hit a high probability entry zone yesterday and rallied up from 339 to 365. It also rallied off that level back here. You can see that same big oscillation bounce. Your objective, once you define these things, is to trade the same thing again and again. So I'll talk about, we've got about 5 minutes left, so I'll talk quickly about what we've got coming up, and then we'll take some questions. We have an excellent workshop that we put together this year. We've been teaching for 7 years. This is the first time we launched this workshop, and it's a great foundation to build off. And I know a lot of our students that have gone through 3 months and 6-month courses with us, a lot of them all came from going through this same module that really launched their results to a new level. Because as you can see, we really like to teach the why, and we really like to give people a lot of value. And this toolbox goes through an extension of everything we talked about today. It goes through, it's a 5-module course, each are 2 hours long. The videos you receive instantly and can go through. And as you go through this, we talk about the smart money, how high frequency trading works, a smart money checklist of all the different things that smart money does and how to be able to research it at the flick of a switch using free online tools. We go through the DNA of the market, money flow, how accumulation and distribution is reflected. So what are the highest probabilities of smart money and how to find those. Also price action and chart patterns. So looking at what the high probability patterns and so forth are. Also high probability candlesticks. We go through that in more detail in the advanced module of candlesticks. But the high value, the really highest value module in all of this is what we're building towards with this knowledge is then how to build the highest probability scans. This module we sell on its own for $397. This just comes part of the entire package for only $97. So this is where we go through and show you how to create these scans, searching for options during earning strategies, searching for markets that are topping, all using free online tools. So no matter what you use, we can help you set the scans up in what you already have, or give you free programs that will do the job for you. It's a what is Module 3? Module 3 is the DNA and blueprint of the market. So this is where we go into kind of a lot of price action, how to draw trend lines correctly, understanding when understanding when money flow is diverging away from the chart pattern and so forth. Divergence and proper trend line drawing is very misunderstood in the market, but it's very, very, very valuable if you do it correctly, because it tells you when one pattern changes, and that's exactly what you need to know in terms of acting. We do have a live Q&A panel. Every Tuesday and Thursday we get together and we talk for about an hour and a half about all of the stocks that people are trading and what the markets are doing. And lastly, we also have 9 a.m. to 9 p.m. Monday to Friday live support, so you can actually contact us if you have any questions or problems. Someone's asking about trading results. One of the things that you'll get as part of this, and I'm running short on time here, got about a minute left. One of the things that you'll be given the option of when you enroll, and that's 97 Canadians, so that works out to be about 87 US. So for the extra $9, which brings you up to about the same price, $97 US, you'll also be getting videos from us where we send you each night a 5-minute video telling you exactly what we're going to buy tomorrow with our money. So we trade, the stuff we're teaching you, we trade with our own money every day. And we'll be sending you a video each day telling you exactly what that is. The last one that we picked was NQ. That was the one I mentioned earlier. And that's what it's done in the last 2 days, 8.35% yesterday, 13% today. So that was one we highlighted just in the video last week. I'm going to have to tie it up here, guys. I'm at the end of my time. That is for a month of those videos. I would be highly surprised if you didn't make that $97 back through having the advantage of research of those reports. So it's been a pleasure, and I'll pass it back now. And if you do have any more questions, you can simply email them in or call in to those numbers and contact details. Thank you very much.